G'day. Today we go deep on portfolio construction and fund manager selection with Daryl Wilson from Affluence Funds Management. Daryl's funds invest in other funds, so who better to really nerd out over how to plan a portfolio and what to look for when choosing fund managers to fill it. This conversation was originally a live chat on my satellite sessions, live shows exclusively for Rask investors and community members. Join the community for more events just like this each month. Daryl Wilson from Affluence Funds Management, welcome.
Thank you. Thanks, Mitchell. It's good to be here.
Excellent. Daryl, I've known you for quite a few years, but I think this is the first time we've ever had a microphone between us. I thought you would be a fantastic guest to start off this series because of what Affluence actually invests in. Can you tell us what that is?
Yeah, so we're different to most other fund managers, and that is to say that we invest a lot of our money through other fund managers. So we run 4 funds. We have a generalist strategy which invests across a whole range of different asset classes, but it's all different. It's different to the standard stuff you would see in your ETFs and your long-only 60-40 type portfolio. So that's the main differentiator there. And then we run 3 specialist strategies, and we've chosen each of those because we've got a specific niche area where we think we can add value. And at the end of the day, if you can't add value over the medium to long term, you shouldn't be a fund manager. So we've got an income product which invests throughout the entire fixed income space, monthly income, which is our most conservative product. And we've got 2 kind of niche equity areas where we invest. One is what we call LICs, or listed investment companies, and I'm sure many of your listeners would be aware of those. There's about 100 of those listed on the stock exchange. They trade up and down at different prices. We invest in there. We've got a very niche strategy there. And finally, we have a small cap value fund, which again, there's a real opportunity to add value through the cycle there, just through finding opportunities that the bigger fund managers can't invest into. So they're the 3 specialist strategies. The core strategy, the Affluence Investment Fund, gives you a slice of each of those smaller funds plus access to a whole range of other, again, differentiated fund managers and other opportunities.
Right. So that headline fund, that main fund feeds into the others and kind of like pulls them together to get the best combination of everything for a total return focus.
That's right. It's a total return focus. Yeah. It's a blend of growth and defensive assets. So at the moment, it's about 2/3 growth investments, about 1/3 defensive. So if you put $100 into the Affluence Investment Fund, about $30 of that flows into those other 3 specialist strategies. The other $70 gets allocated amongst a whole range of other fund managers that we choose, that we think have got really good quality top strategies, and then also a few select opportunities we choose directly in areas where we have expertise. So Greg and I, who run the portfolios, our background before this was in property. So we buy and sell REITs, we buy and sell the LICs, obviously, and a few other kind of discount capture opportunities, which we loosely term, situations where you can buy $1 worth of assets for 90 cents, 80 cents, sometimes 50 cents. And so we love those sorts of opportunities as well, almost a special situations type deal there.
Right, and they're kind of one-off as you see them arise in the market.
They're right. They come and go. At the moment, there's plenty of those opportunities around because, small caps are exceedingly cheap, and that's where a lot of these opportunities kind of come up from. But yeah, you can't predict it. Sometimes, when the market's flying and things are going well, there's generally less of those types of opportunities. But at the moment, you've got this big bifurcation. It's a big word, but basically, the large cap equities, to our view, are overfished and a little bit overvalued, and the small cap are cheap as anything. I've never seen such a divergence for the last 20 or 30 years I've been doing this. So it's an extraordinary environment right now.
Yeah, we were having a chat just before we went live here, and because talking of small caps, I know you run a small cap portfolio, which we can talk about. Our next guest on one of these live sessions is going to be a small cap specialist in Steve Johnson from Forager. So I specifically wanted to get him on because what we're seeing right now, and I think it's structural, in the small cap space. This is a bit of a tangent, but it's all right. We'll come back to the other topic. But you're seeing all the money pile into ETFs, even active ETFs, though, because of the ASX liquidity rules, they can't go fishing down in that small cap land. You then have so much money of Australia's wealth piled into these massive industry super funds that even if they could go fishing in that small cap space, picking a winner down there isn't going to move the needle. But as you pointed out as well, they don't want to diverge from the ASX 300 really, because that's adds risk to them.
Yeah, no, it does. I think it's an extraordinary time, and it's hard to know what will cause money to flow back into that small and particularly the micro-cap space. But it's gotten to the point with valuations where it doesn't matter that much anymore. So if I can just give a quick example, one of the stocks in our small-cap portfolio is a company called Emeco, which is essentially a mining services play. It's trading currently, and it's small, it's growing earnings slowly, it's doing all the right things. It has a very good management team. It's trading on a price-earnings ratio of 7 or 8 and growing slowly every year. Now, at that level, you don't need that thing to re-rate. You don't need a lot to go right. You just need them to continue to deliver a small amount of earnings growth every year, and you're going to get easily a double-digit return. If a takeover happens or a re-rating happens and money floods into the sector, you're going to get a bonus. You're going to make money quite quickly on a stock like that. But you don't need that to happen. And we own a REIT, GDI, in a similar situation where it owns a bunch of Perth office buildings, which is a little bit out of flavour at the moment, I might say. But you're buying that on a yield of 9 to 10% on those underlying buildings. It's fairly well leased. There's not a lot of risk for the next couple of years. And that sort of pricing, coming from the property space originally, that's the sort of pricing I've only seen once before, and that was just coming out of the financial crisis for direct assets. So, there's these examples where you just got to have a maybe 3-year time frame and say, well, I'm just going to put some of these in the bottom drawer, take the nice yield, and wait.
That's great. Well, let's take a bit of a step back. So what we're going to talk about today is portfolio construction, strategic asset allocation versus tactical, and then we'll go into your real specialty field, which is selecting a fund manager, especially when everyone's familiar with the tagline, past performance is no indicator of future performance. So if you're not looking at performance, what are we looking at? So let's take a big step back. So I know everyone with you jumps straight to that, let's select a fund manager. Let's talk about how do you go about building a portfolio around a goal. You've got these multiple portfolios. Let's say income in retirement could be a goal. Growth is someone who's in accumulation mode, aggressively saving, putting money away for that nest egg. How do you go about saying, right, this is my goal, and bringing the pieces of the pie together in those different asset classes?
Yeah. And it's a really good question because it's something a lot of people skip over. And no matter who you are, I think you've got to be very clear about what you're trying to achieve. Vesting's a long-term game for most people. It's 20, 30, 40 years of their life that they're trying to build a good retirement nest egg. And you want to make sure that's grounded in realism and in a strategy that is right for you. So everyone's got their own personal biases. Our bias is value investing, but that's not for everyone, and other people have growth bias or whatever. So I think start with what's your realistic aim? So if I can use our Affluence Investment Fund as an example of that, when we looked to launch that fund, which was 10 years ago now, just a little over 10 years ago, we started by saying, what's a reasonable return goal for a multi-asset portfolio? And we decided that inflation plus 5% was what we wanted to achieve. And so what that means is inflation at that point had averaged about 2.5% for the last 20 years. So that means your goal is about 7.5% to 8% a year. Now, that hasn't been the case for the last few years. It's been a hell of a tough benchmark for us, I can say. And it's surprising how many similar funds have changed their benchmark over the last 3 years and dropped that sort of rhetoric. But that's, essentially what we're saying is for most people, if you can grow your capital by 5% a year, excluding inflation, then that's a good goal. And, we then tested that by saying, okay, we can invest across asset classes. What have the average returns been over the long term for every asset class, for Aussie equities, global equities, bonds, what have you, property? And we put that into the mix, and that allowed us to come up with what we might call a neutral asset allocation. So if every asset class was fairly valued and every asset class delivered exactly what it's delivered over the last 40, 50 years, that would produce that inflation plus 5%. We came up with a mix that would deliver that.
Right.
And then, so that was our kind of true north in terms of what we're looking for. So if we look at any investment for that fund, what we're saying is, can that deliver inflation plus 5% over, and our investment time frame we think about is normally 3 years. The reason we say 3 years is because quite often we're relying on some form of value to be created or some form of mean reversion. And so we've got to give that time to happen. Things don't, if you're investing with a 3-month horizon, you better be in cash because that's the only thing you can reliably estimate over that shorter time frame. So that's the starting point for us. And then if it doesn't meet those hurdles, it doesn't come into the portfolio. Now, that's been incredibly tough at different times. So, for example, for quite a few years, we had almost no fixed income in that portfolio because to find a debt fund or any sort of fixed income investment that could deliver 7.5% when interest rates were zero was very hard. I mean, you were essentially taking a lot of risk to get that. These days, with base rates at 4 and a bit %, it's much, much easier. So we launched a fund 2 years ago to do that.
Right. So you can then dial up your exposure to that because you're then don't want to use industry jargon, but your risk-adjusted return for that asset class was now worth your while of investing in it. And so
Correct.
You don't have to take as much risk by investing in Australian or global equities to get that desired return.
That's right.
You're not just floating along, so to speak, with the market.
Yeah, no, that's right. And so for a long time, we had almost none. In fact, we actually at one point went back to our investment committee and lowered our minimum hurdle to 2.5% for that fixed income asset class because we didn't want to be pushed into having to hold investments just to meet a minimum hurdle.
Right.
So I would say that's the other two factors for all of our portfolios. We want to be very diversified and we want to have a lot of flexibility. So we want to be able to go where we see value at any given time, and that can ebb and flow. Our portfolios don't tend to change quickly, but they can change a heck of a lot over a full cycle because asset classes and individual opportunities move in and out of favour.
Well, going back to what you said about looking at what your goal is, and your goal is a return focus, and then you're lining up all the different asset classes and you're getting the long-term average from those asset classes. Does that then makes up when someone looks at a fund or looks at a multi-asset strategy, you look at the PDS, for example, or the fund memorandum, and it'll have a range, fixed, this fund can hold 0 to 20% fixed interest. It can hold anywhere from 10% to 30% Aussie equities. It has that range. So that's how you develop that range.
That is how we develop that range. And we quite deliberately give ourselves a lot of flexibility. And the reason we do that is because, the market environment changes a lot over a full cycle. And we're always thinking about a full cycle when we look at the investment environment. So we want to be able to hold a very small amount of Aussie equities if we feel like they're extremely overvalued, or a large amount if they're extremely undervalued, as one example. So and even between, so I mentioned earlier the kind of divergence. At the moment, we're actually underweight Australian equities, but almost all of that exposure is in the mid to small to micro cap space because that's where all the value is. So we want the freedom, even within those asset classes, to be able to go where we see the value. Yeah.
So for people at home, what we're talking about there, lining up all your different asset classes and having your ranges, that's what in the industry would be called your strategic asset allocation. And then how you go about getting it, i.e., are we not investing in Aussie large caps and choosing those Aussie small and mid cap names? That is the tactical asset allocation. So you've actually hinted. I've got a question here on the tactical because we're going from the very top of the strategic. We're going to the tactical, and then we'll get into the manager specific. And everyone who is watching at home, please, it's live for a reason, so you can actually ask your questions. So if you do have any, send them in. We'll get to them. So you've hinted at this, a slight bias, but I wanted to ask, are you style agnostic when it comes to the selection of managers and exposures to achieve your strategic asset allocation? Will you always be selecting value-focused, say, Aussie small cap managers now, or is there a time for you to look at growth investors and things like that in your portfolio?
Yeah, it's a question we get a lot. So I think we're very open about the fact that we have a strong value bias. And that's just born out of our DNA. So my background before I was a property guy was an accountant. That's my upbringing. That makes me conservative by nature. Greg's background was a commercial property valuer. Again, fairly conservative profession by nature. We like dealing in hard assets, net asset values that we can determine. So that's driven a lot of our philosophy. And I think it's important for everybody that everyone has a natural investment bent. And you should always make sure that your portfolio is kind of tailored towards that bent, I think. Otherwise, you find it very hard to sleep. If I had a portfolio absolutely full of growth stocks, I couldn't sleep at night because I would be worried about that and I wouldn't fully understand what was going on. So, yes, we've got a strong value bias on average. We do have growth managers in the portfolio. But I would say for us, the last 10 years we've been doing this have coincided with perhaps the most anti-value period I can remember in market history. And so, growth has outperformed value massively. And so we've had even, I guess, less growth than we should have had more. But what's happened is quality stocks in particular have been so expensive for so long, we've had very little exposure to them. And most others, luckily, have had through, if you're following a core and satellite approach, you would have had that exposure through perhaps your large cap US stocks or your large cap stocks generally. So anyone who's using us as a satellite, for example, we've still outperformed our benchmarks, but it's been a really, really tough environment to do that.
It's interesting. Now, I want to ask you, how do you assess value on offer? So we were talking about small caps before, but how do you assess value and whether or not it's a value trap within a whole asset class or within a whole, particular segment of asset classes? So what key indicators are you looking for? Do they change across property to Aussie equities, international equities, fixed interest, et cetera?
One of our mantras is when we look at anything, the way we invest is we try to boil it down to make it as simple as possible, but not too simple. The old KISS principle, you try to keep it simple, but not lose anything that's fundamental. And so the way we look, whatever we're looking at, all of our funds, we approach portfolio construction and sector analysis the same way, which is bottom up and top down. Okay, so by that I mean, bottom up, we're looking at individual opportunities within a asset class or a subsector. And if we find a lot of them, then that generally is an indicator that there is value on offer. Okay, so when all of the LICs are cheap, for example, or a large proportion of them are cheap, that tells you there's probably value on offer. Conversely, if you can find very few opportunities, you're much more likely to be looking at some value traps. And so that's sort of the way we look at it. And then top down, again, if a whole sector screens as cheap on historical benchmarks, and we look at some very basic indicators there. So we look at, for example, in the equity space, we would look at price earnings ratios, we would look at CAPE, we would look at earnings growth, some of the historical margins, for example, and that data is freely available through quite a few different places. So we use a few public information sources and some private as a kind of a top-down check to make sure that our view on each sector is broadly right.
And speaking of that, if we can go around the grounds, so to speak, at the moment we've touched on mid-cap, small-cap Australia being of compelling value right now. What other areas is compelling value for you, and what are you less inclined or less weighted to at the moment?
Yep. So I think in no particular order, Well, I guess I'd say, firstly, from a top-down perspective, I did a talk a week ago on now is the time to be a contrarian. And hey, I'm a value manager. I'm probably going to say that, we're all contrarian, but the problem with contrarian investing is it doesn't actually work 75% of the time. Contrarianism is good at turning points.
Yeah.
And I think right now, globally, in terms of the investing environment, we're at a turning point. So that, step one of that was early 2022 and onwards, when interest rates started to go back towards what we consider to be historic norms. So they went from kind of crazy low to now probably just above neutral. We think the new normal for interest rates is that, if you look at our RBA cash rate, for example, somewhere between 3 and 4.5 is the new normal. And so outside of extreme market situations, that's the band it's going to play in. And so that's meant that the kind of value is going to come back into focus. At the same time, US exceptionalism has been the trend for the last 10 years. We think that's ending. And if I was to take a bet at what will knock it on the head finally, I think it's AI. And specifically, I think it is the fact that...
so not the current administration.
Look, Trump's interesting and everyone's talking about Trump. The interesting thing about the administration is that, occasionally in time, everyone's got a conspiracy theory every now and then, and most of those you just discount because, gold will never go to $10,000 and, all these things that could happen conceivably. The thing about the Trump administration is anything could happen. Nothing is off the table anymore. So things as crazy as a restructure of US debt, for example, which is unthinkable in most periods in history. I wouldn't say there's a large chance of it happening, but you can't discount things like that. So at the moment, if you're trying to take a call on US bonds, I can equally make a case that Trump's going to cause inflation and bond rates are going to go up and bonds will do poorly as the yields adjust. Or I could make a case that Trump's going to cause a bit of a big recession and bond yields will fall and you'll make good money out of bonds as those yields fall. So, and I couldn't tell you which one of those two things has happened. All I could say is it is likely to be one or the other. It's probably not going to be in the middle. So it's probably the most interesting investment environment I've been in 30 years where, anything is possible now. But we think generally inflation will make a bit of a comeback. Interest rates are going to have to therefore be higher than they have been. And that means that we're going to get some form of, I can generally call it mean reversion. So what we're seeing now is the early stages of tech adjusting back to more normal valuations. Europe, UK, even Asia, Chinese markets moving up a bit. And, the interesting thing with, say, Chinese tech is that, in almost every area in the last 6 months, we've seen examples where Chinese tech is better than US tech. And yet the prices of the relevant stock baskets would suggest the extreme other.
Yeah, the big headline one on that, of course, is I think we forget about DeepSeek for a second, but it's BYD versus Tesla.
Absolutely, yeah, absolutely. Yeah. And Tesla's priced for not even as a car company, really. It's priced on some of the other things they're doing that might bear fruit in the future, and that may well happen. But I think the market in the US is going to go through an adjustment this year where they realise that all of this stuff's not going to happen nearly as quickly as perhaps is anticipated, and therefore these companies are not going to make a lot of money in the near term from AI, despite the fact they are ploughing, mind-numbingly large amounts of money into building out data centers and large language models and all of the technology they need to get the AI moving. So I think we're going to see a bit of a normalization, and that how I would say that because that's good for us. But I think that's the second stage of the adjustment. So the first stage was a normalization of interest rates. The second stage is a mean reversion of, Europe makes a bit of a comeback and Australia.
We've seen that happening already, haven't we with Europe rallying. So there are European ETFs out there that I actually was thinking about this last night. So in your seat yesterday, this is a bit of a preview of a podcast upcoming. I had the Chief Investment Officer of Global Credit for PIMCO out from the US. So $2.something trillion bond manager.
Yeah.
And he had a slightly different view on US inflation. He thinks it is going to come down because the US consumer everywhere, every company he's currently talking to, they're tightening the belt. because confidence is quite low. But he was incredibly excited about the opportunities he was seeing. He was incredibly excited about Europe, and he was repositioning the portfolio for European exposure.
Yeah, I think that's generally a trend, and we have within our global allocation quite a bit in Europe.
Has that been something recent that you've moved to, or has it been over the last few years?
I think we've generally moved a bit more into that area more recently, but we've tended to be, as I said, to our great detriment, underweight the US the last 4 or 5 years on valuation grounds. But the valuations have stayed very high. I think now that's changing, and the interesting thing at the moment is, from what we can see at the moment, the smart money is not buying the dip this time around. So we're seeing as US stocks are coming back.
How do you, just for people out there, how do you assess what the smart money's doing?
Look, it's a lot based on, we talk to a lot of fund managers, for example, in Australia, but also around the world. And we got a lot of fantastic intel from, they're all specialists in their particular field. We get a lot of intel from listening to what they've got to say. We get a lot of data. And so, it's not absolutely obvious, I would say, but we're leaning towards that way from just looking at the market reaction to, you're not seeing large buying off the bottom intraday, for example. You're not seeing some of the patterns that we've seen consistently in the last few years during market corrections. So the retail money is still buying, but the kind of larger investors, and particularly the wealthy private family offices and what have you, are just being a bit more cautious this time around.
Right, that's interesting. So now that we've gotten that real top-down view, let's go into the bottom up now. As I said, when it comes to satellite exposure, be it predominantly like small caps, emerging markets, even Europe as well, which is not an emerging market. I know a lot of our audience, me as well, I don't go out there handpicking companies in these regions. I use specialists. I use small cap fund managers. I use global small cap fund managers. For my large cap exposure, I use passive ETFs because they're incredibly efficient vehicles and difficult to beat. Those markets are highly efficient. So let's dive into how you guys would select a manager for your portfolios. Say if we throw out the tagline, past performance is no indicator of future performance. I'd love to know where you put performance and what are the few little check marks that you're running over every single manager that you're looking at.
Yeah. I certainly think, so I've got to be careful how I say this, given your disclaimer. We think past performance can be very indicative of future performance, but not in the way people think. Okay, so Let me be very clear. It's not linear. So if you take the last 12 months and project that forward, that's a bad way to look at performance. In fact, some of our greatest investments with other fund managers have been times when they've got a fantastic long-term track record, but they've had a bad couple of years, right? And normally that happens because markets are cyclical. And so the particular strategy they're using may not have worked well because the markets haven't been in their favor. Okay, but I would say for any fund manager that we put into the portfolios, they have to have outperformed over the long term.
The since inception numbers, the 5-year, the 10-year.
That's right. Yeah. That's right. And we look at as long a period as we can, and we look at things like, it can vary over time. So that's the first thing. They must have outperformed over the long term. Secondly, we ascribe performance to the investment team that's doing the investing. Okay, so by that I mean sometimes the fund manager will remain constant, the name will remain constant, but the team can change a lot. We don't really look at those periods where the same team wasn't together. So, we would back a new manager if it's an investment team that's been together for a long time and perhaps they've come out and started their own firm.
Yes, they've earned their stripes.
Exactly.
And they might have been at a very large institution. You see this happen quite regularly. Some of the really most successful managers have come out of stables like Platinum, for example. There was a lot of people come out from underneath Kerr Nielsen.
Absolutely.
In the day and start funds and have done incredibly well. We've just started to see it happen from a stable like Magellan.
Yep.
They come through a period of upheaval, and you've seen some teams kind of pick themselves up and set up their own shop.
Absolutely.
So for people doing their own due diligence here, on be it a new manager and a pre-existing one of your best ports of call then is to, say, jump on LinkedIn and have a look at the tenure of the teams and things like that.
Well, I would say start by reading everything you can from that manager and ask them to send you more if you need it.
So go back into the archives.
Yeah, or even necessarily just get the most information you can from them right now. So, sometimes we'll ask for information that's not publicly available, or even just as simple as, can you send me your latest presentation, which might not be on their website or might not be available. And so glean as much as you can from them. What we're trying to work out is, okay, so this team has outperformed. The first question you ask yourself is how, right?
Yeah,
what is their secret sauce? Well, because I can tell you now, and when we started Affluence in 2014, we spent 9 months doing a deep dive of every, we basically went through the Morningstar database from top to bottom. There's about 10,000, or there was about 10,000 managed funds. We ran a filter that said, look, tell me everyone who's outperformed by 1.5% per annum over 5+ years. We immediately screened out 90% of those funds. And then we sort of ran a few more screens and we screened out another 5%. So, it was actually quite easy to get down to 200 or 300 fund managers.
A manageable pool.
A manageable pool. And then in reality, a lot of the best performing fund managers aren't even on the Morningstar database because they'll be wholesale only. They might be full, closed to new investment, or
they just don't want to send their details through.
Yeah. They're hard to find. So a lot of it is word of mouth, through talking to other investors. So just get as much as you can. Understand what it is they're doing that adds value, that allows them to outperform. And if you can't understand that very simply, I would say move on. Because sometimes we don't invest in a lot of sort of systemic quantity style funds because we don't believe we could spend weeks on due diligence in one of those funds and still not fully understand how they make money. And they might have a secret sauce, but we can't.
But unless you understand it, and that's really important, if you don't understand it, you don't understand why it's gone up.
Yep.
And really, really importantly, you don't understand why it's gone down.
Absolutely.
And if you don't have that conviction to hold, you might do something that you regret.
Yep.
Crystallizing losses, etc. I think that's really, really important. I'm interested to hear then, what do you like? You like teams that have been well established, either with a track record within that exact fund or outside. Going beyond that, I'm interested to get your take on concentrated funds. Do you like it where the managers are backing themselves and, they might only have a dozen companies, or, versus a fund where you've got 50, 60 plus holdings, which is quite common in small cap kind of land.
Yep.
What do you have a preference there? Or is it horses for courses?
Look, I would say, before I get to that, I'd say just one more thing with your fund managers. I would say meet them if you can, or watch them on a webinar, see them speak, listen to the team.
Listen to a podcast. There's 100
listen to a
them.
podcast. Yeah. It's vitally important that you understand, at the end of the day, if you're giving a fund manager your hard-earned money, you've got to be able to trust them. You've got to understand what they're doing, how they're doing it, and whether that suits your investment needs. Because if it doesn't, you will struggle. Even if they do outperform, you might struggle eventually.
Do you think you can determine from the documents you receive from fund managers and from how an investment menu is written up and how they display their fees, how clearly they articulate their performance fees, how they've structured those fees? Do you think that's a bit of a read as well on the character of the person running the fund?
It can be, yeah. And certainly, a lot of what we call our confirmatory due diligence is just going through and methodically documenting, who are their service providers? Are these names we know and trust? What's their fee structure? Is it fair? And this is particularly the case in fixed income at the moment, for example. Is the sharing of risk between the fees and the returns that investors get fair?
It's there's a fair bit of fat in those fees.
There is sometimes
in some cases.
Yeah. And because of the way we do things, I'll tell you up front, we run essentially a lot of it is a fund of funds. And so we're obviously paying fees to the underlying managers, and we get a fee. And the way we get around that issue is we charge only a performance fee. So we say, well, if we deliver a zero return, we get zero. No one's happy, I can tell you about that. If we give you a great return, the fees will be high. You won't care because you'll be happy. So that's the fairest way we can do it. But everyone's different, and that's a big thing. And coming back to the other thing, the reason I say talk to managers is there are some personality traits we find again and again and again in managers that are successful. One of them is humility, and that goes to things like admitting your mistakes and talking about them and explaining what you learned. Competitiveness, you'll have Steve on next week. He's very focused, very competitive guy, and he wants to win. He wants to win for his investors, and that's important.
Some of the best fund managers I've come across have actually come out of high performance sports backgrounds.
Yep.
I've got a good friend of mine who played cricket at an incredibly high level, like junior kind of Australian kind of size. So he understands that performance aspect, and he runs a very successful fund himself. Steve Johnson's background was rugby league. He played a rugby league at a very, very high level. And there's quite a few people that have come out of those high, performance backgrounds that go on to be successful managers.
Yeah, and I think there's a lot of traits in common, focus, dedication, continuous improvement, for example. And the other thing we see quite often is a lot of great fund managers are introverts, because they're happy to be locked in for want of a better word, locked in a dark room and just be able to focus on stock picking. That's when they're at the happiest.
Yeah.
And they also tend to be risk aware, So, again, if people talk as much about their wins as their losses, and then you sort of understand they're thinking about what could go wrong, that can be another key indicator.
That's interesting on the introvert side of things as well, because you might naturally lean towards someone who presents better.
Yep.
And quite often, some of the best managers I've met have been, as you said, quite introverted, but also almost to the point of rudeness.
Yeah.
Well, so you just have to get,
because
that's just the the personality trait. They're not, but they're not meaning to be. But
I've walked out of plenty of rooms, plenty of meetings with fund managers where I've thought that their level of intelligence is on a different plane to mine. I mean, they're just absolute geniuses. So, and that's why, the reality is, if you're a great fund manager and you've got great performance, you don't actually need to market yourself. People find you. If you're a terrible fund manager, you need great marketing, and so that's basically, then you need the talking head. But I think some of the world's most well-known hedge fund managers don't have great performance, but they're great to listen to. They've got lots of good ideas. They'll tell you everything they did right and nothing they did wrong. So, ultimately performance wins out.
All right, let's talk about the alignment of managers. Mm-hmm. So you look at the fee structure, you see the performance fees. Do you care if they are invested in their own product, or is the fact that they're running the fund, maybe it's a boutique, it's their own business, the name's on the door, is that enough?
I would say we're looking for two things. We really do want them to have what is a material amount of money for them invested in their funds.
In the actual fund.
It doesn't have to be in the actual fund. It can be in a parallel strategy, or perhaps, in some cases, they might run a range of funds and they're invested in 2 or 3 of them, but not all of them. I can tell you for us, Greg and I, the very first dollar that went into each one of our 4 funds was our own money. We started with our own money in most cases before we launched the fund to make sure we're happy that it works. We built out the portfolio. And so we want to see that co-investment, call it for want of a better word, within the funds management, within the suite of funds. Because if not, why are you there? The second thing is we want to see the managers themselves ideally have a stake in the business, particularly for the key fund managers. So you're wanting to see that they have skin in the game one way or the other. Fees is a bit of a nuanced discussion. Sometimes managers charge high fees and sometimes they're worth it. If they're running a very constrained strategy where they're making good money, but there's a limited amount of money. So, for example, a lot of the managers in the small cap space, their biggest problem is going to be taking too much money. So they could take a lot of money and charge a lower fee. They will not outperform. Or you can take a little bit of money and charge a higher than average fee, and you've got a much, much better chance. Notwithstanding the higher fee, you've got a much, much better chance of outperforming. So fees we look at as, is it fair in relation to what the manager's doing, the sort of returns that could be generated, and how constrained the strategy is.
A quick one. I'm quite interested in this topic of boutiques versus institutions versus multi-manager distribution channels. Now, it's a lot of jargon there for our listeners, but I want to. So what I'm referring to there, boutique, it might be a one or a 2 or 3 man shop where they are a very small team running 1 or 2 funds only. So, for example, Forager is an example of a boutique. An institution is like a very large company, like you might have like Macquarie and their small cap fund and things like that. And then a multi-manager distribution model for people aware of these names might be, say, a Pinnacle, for example, who they provide all the back office support, marketing support, etc., and then they take an ownership stake in a boutique and let that boutique go out there and just do what they do best. So that manager will just be a team of analysts and that's it, and they outsource the rest of it. Do you have a preference, or is there the pros and cons to these different models?
I would say so. We would have all 3 types of fund managers in our stable. The models all can work. The one thing that's a non-negotiable for us to get into our portfolio, you've got to be doing something genuinely different. So, as you mentioned earlier, it's hard to outperform just investing in the ASX 200 or the 100 because it's an overfished space, and to add value is very difficult. So everyone's doing something different. We've got, I could think of an institutional grade manager in someone like Pzena, for example, which our readers or our listeners, probably wouldn't have heard of, but they invest globally. They're a value manager. They invest in large cap stocks, but they're basically trying to fish around in the cheapest quintile of the market, buy things with strong balance sheets, and sell them again when they re-rate. So that's an institutional grade manager. The likes of the large super funds would invest with them. Very good model. Pinnacle is a fantastic business, and a whole range of their funds are very, very good products. And the team at Pinnacle are very good at putting together, picking teams, managers, and strategies to back, who again are differentiated and can do good things. And there are plenty of good boutiques in our. Again, the concept of 2 or 3 people on an investment team sitting in a room, just investing away and not getting bothered by anything else, it can work beautifully as well. We say the best fund managers are those who are really bad at marketing but really good at investing, because we can give them money forever and they never get full.
So if you that's great. If you go to a website and it looks terrible, are you guys like rubbing your hands together?
That's quite often a sign. Yeah, if there's not much information floating around, and particularly quite a few of our managers are closed to new money, or in some cases closed completely. So every now and then they'll open the doors for a while and they'll just get flooded from existing clients, and they'll get as much as they want and they'll close the doors. So those sorts of managers can be very, very good. Mm-hmm. And also within a large stable. So for managers like Cooper Investors, which is one some of your listeners may have heard of, they run probably 10 or 12 different funds. When we look across their fund suite, we say, well, where's the founder's money? Where's Peter Cooper's money? And the answer is it's mostly in a fund called the Brunswick Fund, which is has quite an open mandate. It's probably the most free investment strategy they've got, and we'd follow into that fund. So quite often when you're looking at a range of funds, you just follow the founder and look at what they're doing.
The Brunswick Fund, I'm fairly familiar with it because I think it's a really interesting strategy, and it might get overlooked by the average person just scrolling through and ticking boxes on show me international or just show me Australia, and they're trying to really just carve out those asset classes and stick to their percentages because, correct me if I'm wrong, but it invests both in Australian and global companies within the one fund.
That's correct.
And so you do have, it doesn't fit neatly into that asset class kind of metric that people are trying to put things through.
No, but it's interesting. So two things, the main two things that cause funds to underperform. Well, three things really. One is fees, obviously. If you can't generate enough alpha to cover your fees, you're in trouble. But the two main reasons fund managers can't generate enough alpha to cover their fees is that they get too much money or money too quickly. So when you've got a lot of money coming in and you can't invest it quickly enough, you tend to be putting your 10th best ideas in. And the second one is really where, and this mostly happens in larger fund managers, where the investment team gets risk management 101 put on them, and they are really constrained in terms of how they can invest. So they have a low, what we call tracking error. They have limited amount of flexibility to go outside the benchmark or to go under or overweight stocks, and nothing will hurt your performance quicker.
You can generally see how much fund a fund has. You can generally see that on their monthly reports and whatnot. Typically, or just ask as well. How can you see when they've been weighed down by that compliance?
It's a bit harder to find, but certainly it should be in their PDS or their disclosure document. You can ask them what their investment limits are.
So if it's quite tight.
If it's quite tight, if it's very constrained, and if generally they're carrying a lot of stocks. Going back to the question you asked me, I never answered on concentration. If you've got 200 stocks, it's hard to outperform because, quite frankly, you're better off to own an ETF or an equal weighted ETF or at that point. And you just can't have enough of any one stock to make a difference unless you're doing something systemic or weird. At the other end, extreme concentration, we usually struggle with as well. So if you've only got 10 stocks and you completely stuff up 2 of them, that's really going to hurt your performance. So we don't mind.
There's a couple of licks out there that I can think of right now that have run 12, 15 stock portfolios, and you don't need much to go wrong.
No, there's one in particular I can think of, which I won't name, which has had a massive problem in the last month, where one of their main stocks has fallen 90%, and that was a big holding for them. So, but I would call out one that I think does it incredibly well. There's a small LIC called NGE, which most of your listeners probably haven't heard of. Melbourne-based. Yeah. I saw one of the investment team yesterday. Small LIC, they've got really good investment results over a long period of time. They can be fairly concentrated. They can at times hold 10 to 20% in a single stock, but they've tended over a long period of time to get that fairly right. So that's a case where we'd certainly back.
Also a case of where they stick to their knitting a little bit because it is, correct me if I'm wrong, very energy focused a lot of the time. I think they took a quite a big swing at uranium. For example, they held a company, Yellow Cake.
They did.
Got it right.
They did. And they're good risk managers, I would say. So even though they hold big positions, if you're going to be concentrated, you have to be an extremely good risk manager to be able to handle the fact that, your biggest positions need to be ones where the upside is much more likely to happen than the downside.
Okay.
So
I want to just quickly move on when to change managers. I think we have touched on that a little bit when you see those inflows get up, when that performance starts to struggle. So you're looking for that, the performance struggling is okay because it's cyclical, but if it's maybe for these other reasons that are creeping in?
Yeah, so I think one of the core when we're speaking to an investment team, when we're first looking at a fund, we're kind of trying to get in their heads and we're trying to understand, okay, what's your secret sauce? What are you doing? And that then leads to a discussion around, well, when will you outperform and when will you underperform? Yeah. Because no fund manager can outperform all the time. And so that's very, very important for people to understand. And so it's really about, for us, and this is part of our portfolio construction as well, it's like, well, what conditions would make you happy? What conditions will you outperform in? What conditions will you underperform in? And, for us, for example, weirdly, we tend to do our best work, relatively speaking, in poor markets, right? So last month, the ASX fell 3 or 4%. Our LIC fund was up like 0.3. So that's fantastic if you can get that. Other managers who've got very good track records will have been down 8% last month. So it's important to understand. So we're looking for, when we see a glitch in performance, firstly, is it explainable? And if it is, and we understand why that is, we may well at some point top up when we see conditions changing more in their favour. Alternatively, if we see something we didn't expect, so perhaps it's been a really good environment and they've underperformed, we immediately want to understand why that is. Have we misunderstood what they're doing, or are they not doing what they said they were? And either of those two things are, one of those is on us, the other one's on them. So in either case, that could lead us to re-rate. So performance, we monitor it closely. We can be quite forgiving of underperformance if there's good reasons for it, but if there's not, the opposite will apply. A lot of money quickly is a bad sign. One of the key investment team leaving for us, even though it may not ultimately be a bad sign, we would tend to perhaps redeem first and ask questions later. So if there's a team of 2 and one of the founders leaves, that it's not the same dynamic. And so we would tend to be conservative and probably redeem at least half, maybe all of that holding. They're probably the main things. I think, generally when we put money with a fund manager, we want to be there for the long term. We don't often redeem. Our average holding period is 3 to 5 years plus. And so absent surprises, we might move up or down. The other reason we might move out of a fund manager is where markets have changed. Okay, so at the moment, for example, we've been increasing our gold mining investments through other fund managers in the last 12 months. But we've probably moved down the market cap field. So, the gold price has gone spectacularly well in the last 12 months, but the junior gold miners have hardly moved at all. The large miners have moved, the medium ones are starting to. And so you almost want to be ahead of that game by moving to large to medium to small as excitement takes hold. And you can make spectacular gains in the junior miners maybe 1 year in every 10. So for 9 years in every 10, you're wasting your time holding them. So we've been increasing that sort of exposure. But the opposite will occur if we make good money or if something changes, we'll move out of those. And in particular in the LIC space at the moment, we hold two LICs that have a reasonable weighting to junior gold miners. So they are LRT, the Lower Resources Trust, and LSX, Line Selection. So both interesting. Perhaps they've already had good last years, but perhaps this is their time to shine. And then, they're probably not stocks you necessarily would hold at the same weighting, at least through the cycle.
No, true. Let's just conscious of time. So I want to, and I'm going to do this on every single satellite session. I'm going to call it the pitch. And let's say an affluence fund, it can be any of them that you've got, right, is to be included as a satellite position to someone's balanced growth or high growth diversified portfolio. How do you position it alongside them, and what is its role?
Okay. Well, I think for us, at the core of all of our funds, we're trying to do 3 things for investors, 4 things really. So the first thing is, as I mentioned before, we're different. Okay, so if you've got your large exposures, your large cap exposures and your bond exposures, we're not that. We're everything but that in a lot of cases. In fact, our Affluence investment fund specifically is everything but that. So you're getting different with us. And then with each of our funds, we're trying to do 3 things. We're trying to outperform over the long term, a fair benchmark. So whether that's the ASX 200 in case of our LIC fund or the small cap index in the case of our small cap fund. And we have tended over the long term to outperform by about 2% a year. Not every year, as I said earlier, we'll have underperformance years and overperforming years. But in a tough investment environment for us to have delivered that, we're very, very happy. And I think a lot of people have to be aware that, the long-term average returns are perhaps not what you think they are. So the returns we've seen out of the US market in the last 10 years are spectacular by historic standards. That sort of 12 to 15% a year is incredibly abnormal and probably isn't going to happen in that market in the next 10 years. So we're giving you different. We're giving you perhaps weighting to value. We're giving you weighting to those things that are going to hopefully have a re-rating in the next 2 or 3 years. And then the other two things we do is all of our portfolios have some form of income. So we tend to say we want to deliver at least 5% per annum, and we want to be able to pay that at least quarterly, in some cases monthly. Now, whether people choose to take that income or to reinvest it is up to them, but at least you've got the option. And the third thing, which again I've mentioned previously, is that lower volatility. So we tend to, yes, we outperform over time, but it's interesting that most of that outperformance comes in market corrections where we are less worse than the market. We struggle to keep up when markets are ripping ahead, and then when markets are sort of going sideways, hopefully we're up a bit. So that actually is what we think, and this was born out of our history in the property game. Most investors are looking for that. They're looking for decent returns, a bit of income for those who want it, and to be a friend when markets are in trouble. Because if you can manage the downside risk, you're that much closer when markets turn to getting that back and being ahead again. So if you can be ahead again in half the time of the market, that's exceptionally good outcome.
Right. So it's a good, say, against any of the growth, a balanced or a high growth kind of style portfolio, it's a good position to provide a bit of balance and also a bit of a suspension for those drawbacks.
Absolutely,
when they make.
And I think depending on each investor's got their own expectations in terms of risk and reward. So having now that income fund, which we added to the portfolio 18 months ago, was a very, very important addition to our family. We've now got we've got that lower risk, reasonable return income fund at one end if you're looking for something conservative. And at the other end of the spectrum, you've got the small cap fund, which is, a little bit of income, but that's mostly a capital growth play. And the other two funds sit somewhere in between. So depending on what you're looking for, boy, we've got the fund for you.
I did call the pitch. I did like that out at the end. Daryl, I really appreciate you joining us, mate. It's great to catch up again. And I hope everyone in our Rask Core program and our Rask Invest enjoyed that. If you've got any feedback, please send it in to me. Love to hear from you. And we'll be back next month. Steve Johnson coming in next month to talk specifically about the opportunities we're seeing in the small cap space. But if there's anyone that you specifically want to see in this seat, please let me know. I'm open to all suggestions. But for now, Daryl, thanks for joining us, and we'll catch you soon, mate.
It was a pleasure. Thanks very much.
Cheers.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.